17th edition video solution walkthrough for problem 16.6. This is the intermediate accounting textbook, authors Don Kiso, Jerry Wangan, and Terry Warfield. The questions used in this presentation are copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. And this solution presentation is copyright 2019 to 2021 by Bennett Tchaikovsky. All rights are reserved. And these are my opinions and not the authors of the textbook or Wiley or any of my other employers or other affiliated organizations. So let's get right to it. Okay, so going right over here, so we're at problem 16.6. And the crazy thing for me in terms of going through these questions, and this is with earnings per share, is like, wow, this is heavily involved. There's a couple things I am going to say about the textbook and things that I would really want you to kind of be mindful of. And that's really when it comes down to the par value of common shares. It's not really shown in this question in particular, but it's one of those things that we just have to kind of be, I want you to really be aware of it, because if you started up a corporation with $1 par value, that's going to be a problem. Okay. So let's go through and kind of start talking. Let's go through their questions. So identify whether the capital structure of Melton Corporation is simple or complex and explain why. So when we're dealing with earnings per share, you have basic and we have fully diluted. And really the key thing is with if it's simple or complex, are there items that can be converted into common stock? For example, stock options. Is there debt that is convertible? Are there preferred shares of common stock which are convertible? So when we look at what they have here, the first part of this is that so both years the company incurred a 10% interest expense on 2.4 million in debt, an obligation that requires interest only payments for 5 years. So when we look at this here, right, this 2.4 million of debt, there's nothing about it being a certain amount of bonds or being convertible. So we don't have to worry about that debt. We just have to worry about the interest on it. Over here, the capital structure of Melton consisted of 1 million shares of common stock outstanding and 20,000 shares of $50 par value, 6% cumulative preferred stock. Notice here that it's not talking about convertible preferred stock. It's basically cumulative, meaning that the dividends, if they are unpaid, that obligation goes from year to year when the company does go through and pay dividends. There were no preferred dividends in arrears, which is good, and the company has not issued any convertible securities, options, or warrants. Ding, ding, ding. So we're here at a simple capital structure. And it's because there is nothing over here where something can be converted. Okay, so when you see this item here about a stock dividend, that has nothing to do with a convertible security. That just means that we're increasing the number of our outstanding shares. Okay, so let's take a look. So we've done this here. Identify whether the capital structure of Melton is a simple or complex capital structure and explain why. So we just did that. It's simple because there are no convertible securities, options, or warrants. So it is a simple capital structure. Okay, so determine the weighted average number of shares that Melton would use in calculating earnings per share for the fiscal year ended May 31st and May 2020 and May 31st, 2021. So let's go ahead and take a look at where we are. So over here, and when we're talking about weighted average number of shares, since the preferred is not convertible, we're just going to be concerned with our common stock outstanding. Okay, so right over here, so our very first date that we're going to be concerned with is 6/1/19. Why is it 6/1/19? Because our first fiscal year is ending right over here of May 31st. So that means the beginning of the year was June 1st, 2019. So the capital structure of Melton on June 1st consisted of 1 million shares of common stock outstanding. And the preferred stock, we're not going to worry about that right now. Okay. So on October 1st, 2019, Melton sold an additional 500,000 shares at $20 per share. Okay, which is fine. So on 10/1/19, we went through and we issued 500,000 shares. Okay. Now, the next part of this over here is that it said Melton distributed a 20% stock dividend on the common shares outstanding on January 1st, 2020. Okay. And then it tells us over here, Melton was able to sell an additional 800,000 shares of common stock, and that was going to be on December 1st, 2020. Okay. So Melton distributed. So this is going to be what we're really trying to do is here is we're trying to figure out 5/31/20. We want to know the outstanding shares. When we're looking at 5/31/21, this is where the over here, December 1st, this is when we're going to deal with the 800,000 shares. Okay. Now, what happens with a stock dividend? Basically, for those holders of the common stock, we're going to give them more stock. This question is not asking us to do the journal entry to record the stock dividend. Rather, what we're doing is what is the impact on the outstanding number of shares? So what's going to happen with this over here? Well, this is going to go from 1 million to 1.2 million, right? Because I'm going to be multiplying that by 20%. If I'm giving a 20% stock dividend, that's what's going to happen here. Now, for this 500,000 shares, because the stock dividend, or 1/1/20, since the stock dividend occurred after this issuance over here on October 1st, right? So this happened on 1/1/20. These are also going to be increased by the amount of the stock dividend. One of the things I've noticed as I've been going through these different questions is that if you ever see a stock split or stock dividend, you've got to go through and adjust all of the numbers. Okay, so that's how it's going to impact your outstanding shares, or all the numbers prior to the split. Okay, so now we get over here to May 31st, 2020. Now, the way that I like to do my calculation of outstanding shares might be a little bit different, and I know it's different than the way the textbook does it. So the way I like to say here is, well, what did I really have? Well, basically on 6/1/19, I had basically 1.2 million shares, right? So 1.2 million shares. These were going to be so this is going to be outstanding for all 12 months. Right? So I'm trying to figure out the weighted average shares outstanding. So what I'm going to do here is I'm basically going to take this 1.2 million, multiply it by 12/12 because this was outstanding for the full length of the year, and I'm going to get 1.2 million. Over here, though, with basically on October 1st, 2019, this was 600,000 shares. It started at 500, but because of the stock dividend, that new number is 600,000. However, this was not outstanding for the full length of time. How many months was this outstanding for? Well, October 1st, 2019 through the end of our fiscal year. This is going to be a total of October, November, December, January, February, March, April, May. It's going to be a total of 8 months. So what I'm going to do with this 600,000 is I'm going to multiply this by 8/12. So my weighted average shares outstanding as of as of May 31st, 2020 is going to be 1.6 million. Okay. Now, this is at the end. So basically, this is our weighted average shares outstanding as of the end of the year. Okay, so again, let's just kind of go through and see how we got that. We started off with 1 million. We had to adjust it for the stock dividend. So that's going to increase that amount by 1.2 million. Same with the October issuance. Now, when it comes to computing the time or the outstanding, this is how I do it. The solution in Wiley is a little bit different because they take one of these numbers, they multiply one by 4/12, they are one by 8/12, the other one by 12. I don't look, this to me is easier, whatever way works for you, as long as you're getting to the right answer, that's all that matters, right? So this to me is a better visual representation. Okay. So that's how we're getting the weighted common shares outstanding. So this is what we're going to be using on our income statement. Now, as of 5/31/20, right, the actual number of shares outstanding is going to be 1.8 million, right? This is going to be different than the 1.6 million for the year end, or basically during this year, because these 600,000 shares were now not outstanding during the full length of time. Okay, so that's why we had to multiply this by this fraction, because they were issued on October 1st. These shares are not the same as this when you're coming up with our weighted average common shares outstanding. Okay, but once we get to the end of the year, right, it's the actual number of shares is not 1.6 million, that's just the weighted average. Now we're really at 1.8 million, or these two values right up here. Okay, so now we're at 1.8 million, and we had another issuance, right? So the other issuance that we had was right over here. On December 1st, Melton was able to sell an additional 800,000 shares of common stock at $22 per share. Notice here, we're not concerned with the journal entries for that amount or for this, but what we're more concerned with is, how many shares and when were they issued. So over here, I've got 800,000 of common shares being issued on December 1st, 2020. So the actual number of our shares outstanding at the end of the year is going to be 1.8 plus 800,000, or 2.6 million. But that's not the answer we're looking for, right? Because when it comes to weighted average, both of these numbers are going to be a little bit different. I'm just going to call this 6/120. I'm going to move this down here. This value here was outstanding for the full amount of the year, or basically 12/12, or 1.8 million. When I look at this value here on December 1st, 2020, this was not outstanding for the full length of the year. Rather, this is from December 1st, 2020 through May 31st, 2021, which is the end of our fiscal year. This is going to be a total of 6 months. Okay, so I'm going to multiply this value here by 6/12, or this is going to give me 400,000 shares. Okay, so our weighted average common shares outstanding is going to be over here. This is going to be 2.2 million. Okay. Now, if we were to go through and say, like, what's going to happen next year? Well, what would be happening next year is we are going to be starting out with, well, basically 2.6 million, right? The fractional amounts here are only if we're figuring out during the year when these were actually going through and being issued. Okay, so we now have that part. Now let's get to the fun part. Okay, so prepare in good form a comparative income statement beginning with income from operations for Melton Corporation for the fiscal years ended May 31st, 2020 and May 31st, 2021. This statement will be included in Melton's annual report and should display the appropriate earnings per share presentations. Okay. Whenever I think of Melton, I always think of Melton on Office Space, and I want my red stapler. Okay, so let's go right over here. So we got Melton Corporation. Income statements. Okay, so we're going to say over here for the year ended, for the fiscal year ended. Wow, I'm not used to writing May 31st. Okay, so I've got over here for the fiscal year ended, and then I've got 5/31/21. Okay, now for this right up here, they're saying that they're preparing the statements. Now, the income from operations for the fiscal year ended May 31st was 1.8 million for 2020 and 2.5 million for 2021. Okay, so income from operations, or operating income, how does that sound? Okay, operating income was 1.8 million. And it was 2.5 million for the year, the fiscal year ended May 31st, 2021. Okay, and let's just go ahead and just drag this down. Let's drag this down a little bit over here. Okay. All right, so there we go. Okay, so right over here, the next part of it, in both years, the company incurred a 10% interest expense on 2.4 million in debt. Now, if you remember, how does a multi-step income statement work? We've got sales minus cost of goods sold equals gross profit, right? Disgusting profit less SG&A, selling general and administrative, is going to give us operating income, right? From this, we're going to be adding or subtracting, right, other expenses. Okay, interest expense is going to be one of those other expenses. So over here, we're going to have less interest expense. So what is our interest expense going to be? Well, the interest expense, my debt is going to be 2.4 million. Okay. My interest rate is at 10%. So my interest expense is going to be 2.4 million. They made this very easy for us. Okay. So my interest expense is going to be 240,000 for both years, because that's the amount of the debt that was basically going through. Okay. So now it also tells us too, so our net income from continuing operations. Why am I saying continuing operations? Because we just got a big surprise. The big surprise is right over here. We've got a loss from discontinued operations of 600,000. So what is it that we have to go through and do? When we have a discontinued operation, right? If you go to my videos for chapter 4 of Wiley, what you'll see is that these have to be separated from our net income from continuing operations. So our net income from continuing operations, okay, or basically net income, we can call this pre-tax. Net income from continuing operations is going to be 1,560,000. Okay. Our income taxes are going to be 20% of this amount, right? This is 1.56 times 20% tax rate. Over here, this is going to be, my pre-tax amount is 2,260,000. I multiply this by 0.2, which is basically 2.26 million times the 20% tax rate. So my net income from continuing operations is going to be 1,248,000, 1,808,000. Okay. When I have discontinued operations, what I now have to do is say less discontinued operations, net of tax. Okay. So here, this amount is going to be 0. But over here, it tells us that the company experienced a loss from discontinued operations of 600,000. So we have to assume that this was going to be pre-tax. So the after-tax amount is going to be 480,000. Okay. So when we have this over here, we're going to want to say net of $120,000 tax. Note, I'm not making a distinction right over here between 2020 and 2021 because basically the value in 2020 was 0. Okay. All right. So my net income is going to be 1,248,000. And over here is 1,328,000. Okay, so that's our net income from continuing operations. Now, when it comes to earnings per share, how are we going to compute that? It's going to be net income minus preferred dividends. Okay. And this is basically going to be divided by my weighted average shares outstanding. Now, the one thing about discontinued operations is when we're showing earnings per share, it's extremely important to the user of the financial statements that we are able to kind of go through and highlight to them what is it basically, what is it from continuing operations, what is it going to be from discontinued operations. So what we're going to have over here is we'll call this earnings per share continuing operations less earnings per shares discontinued. It's going to give us earnings per share, just basic. I'm just going to pause this real quick. You can kind of see, so this is CBIZ. They're actually a publicly traded company accounting firm. I've used this example before, but right over here, you'll see basic, continuing, discontinued net income. Now, why do they have basic and diluted? It's a complex capital structure, meaning that they have dilutive securities. Most every single publicly traded company will. And it's basically just because of the fact that they're going to give their employees stock options. So, but that's how this will kind of go through and look. So that's what we're going to have kind of down here at our bottom. Okay. So as we look at this over here, you know, how do we have to go through though and figure out our earnings per share? So let's make this really nice and wonderful. So we'll go earnings per share. We'll say continuing operations, discontinued operations, and then we have net income. And we're going to call this, we're just basically, I'm not sure if we would actually say basic, but we'll just go ahead and say this over here, because basically, we may not even have to say anything like that. So we could probably, let's see. We could probably just go over here and just kind of leave that part of it out. Yeah, we don't really need to say anything about that. Okay, so we'll just say earnings per share. I think if we said the word basic, it might imply that there might be something that's fully diluted, so we'll not worry about that. Okay, let's do 2021 first. Okay, so for 5/31/20. Right, my net income is $1,248,000. I have to though subtract my preferred dividends. How do we figure out the amount of the preferred dividends? Well, right over here, it tells us that the company had the capital structure consisted of 1 million shares of common and 20,000 shares of $50 par value, 6% cumulative preferred stock. So the way we're going to figure this out is basically for the amount of the preferred dividends is we're going to take basically the shares. So my preferred shares were 20,000. My par value is 50. And then my dividend is going to be at 6%. So over here, this is going to be 20,000 times 50 times 6% or $60,000. So my preferred dividends are going to be at 60 grand. Okay. If you're ever dealing in publicly traded companies, you're really not going to see preferred stock. It just doesn't, there's a lot of different reasons for it, but we're using it here. So let's have fun. Okay, so I'm going to take 1,248,000. I'm going to subtract 60,000. And that's going to give me 1,188,000. I'm then going to go through and divide this by my weighted average shares outstanding for 2020. And we basically came up with over here so this here is going to be 1.6 million, or why don't we just copy it from up here? There we go. And I'll even highlight this to make it nicer. There we go. Copy this from here. There we go. Okay, so right over here from continuing operations, the amount is going to be 74 cents. So I'm going to set 74. Okay, this is going to be 0. And then over here for net income, it's going to be 74 cents. Okay. Now, that's for 2020. 2020 was easier, or 5/31/20 was easier because there was no discontinued operations, right? It was all happening here. So now we get over here to 5/31/21. So for the continuing operations, what I'm going to do is I'm going to take over here, basically for 5/31/21, it's going to be my net income of $1,808,000 minus 60,000, which are my preferred dividends. Okay, so this is net income continuing minus preferred dividends. I'm going to divide this by the weighted average shares outstanding. So my weighted average shares outstanding for this particular time period is going to be 2.2 million. So when I have 1,808,000, right, 1,808,000 minus 60,000, which are my preferred dividends, divided by 2.2 million. What I'm going to come up with over here is a earnings per share from continuing operations. Is we're just going to say over here, we're going to round this to 0.79. Okay. Let me just flush this out over here for you. Okay. So this part here, we're going to call this 0.79. Now, for the discontinued operations, we're just going to take the amount I'm going to divide that by the weighted average shares outstanding. Okay, so this again is going to be basically 2.2 million. I'm basically using the negative 480. Okay, so when I divide this through, I'm going to come up with 0.22. Okay. Now, my net income should basically be at 0.57. Let's just make sure that that is in fact the case. So right over here, so my preferred, my net income from continuing operations was 1,328,000. I'm dividing that by 2.2 million, and I'm coming up with over here of, oh, I think I forgot to subtract. Hold on just a moment. I have 7, but the reason why I couldn't get it to work, I can basically subtract these two values here. Or what I should be doing is taking basically my net income from continuing operations of 1,328,000 minus the 6 preferred dividends of 60,000. So if I take this minus my preferred dividends of 60, and I get 0.576, which is basically the same value that I got up here. Okay. So this is going through and basically how we're going through and doing the earnings per share calculation. So why is this part so important? It is for the reader. The reader needs to know where our earnings per share is coming from. If we have discontinued operations, this has to be highlighted separately. If you're looking for a review of discontinued operations, I would go back to chapter 4. I have some videos on that you can take a look at. In any event, I would like to give a huge shout out to Wiley for allowing me to going through and to use their questions in creating these videos for you. Please don't forget to like and subscribe. It does make a difference. If you need solutions to other questions from this textbook, please feel free to leave comments. Have a great day, and I look forward to seeing you on the next video. Have a great one.